This is the WealthAbility for CPAs show. Better clients, better practice, better life. Here's Tom Wheelwright.
Welcome to the WealthAbility show for CPAs, where we're always discovering how to build better clients, a better practice, and a better life. This is Tom Wheelwright, your host, founder, and CEO of the WealthAbility Network. So the IRS is getting $80 billion more in this new Inflation Reduction Act. What does that mean for you? What does that mean for your practice? What are the good sides of it, if there are some, and what are going to be the challenges that we're going to have to face? And with me today, I have really one of my favorite tax historians, and this is Joe Thorndike from Tax Analyst. Joe, welcome.
Hey, it is my pleasure to be here.
So, Joe, if you could just remind our listeners what your background is and what you do.
Well, I have kind of a one-off background, really, right? I am a real historian, like the PhD kind of historian, but I have been working in tax for better than 25 years now. I am a contributing editor at Tax Notes magazine, where I've been writing columns on policy and history since 1995. I actually started there in the 80s, believe it or not, right after tax reform. But I did a little stint in grad school in the middle. So
that's awesome. So thank you for joining us, Joe. So I think a lot of CPAs are quite concerned about this. We have CPAs who have never actually handled an audit before, who are going to see their first audits. But let's first of all talk about what the IRS historically, if you look at this bill and you look at historically what the IRS has done, when they get an infusion of money like this, where's it going to go? Janet Yellen says that it's going to increase the rate of phone calls they answer from 15% to 85%. Not quite sure why their goal isn't 100%, but apparently that is really good for them, is to answer 85%. Do you think that we will see a significant improvement in service in the IRS?
Well, I mean, it would be hard not to, right? I mean,
there's only one way to go, is what you're saying.
It's been pretty bad, especially in recent years. But the agency has been sort of famously terrible about answering the phone, right? That's everybody's biggest complaint. Now, honestly, people have been complaining about the agency answering the phone for decades, but this is the whole new level these last several years. It has been flat out impossible for many taxpayers and their representatives to actually get in touch with the agency for long periods of time. And I mean, any person who's filed their tax returns or has helped a client file their tax returns has horror stories about, receiving letters with deadlines that are already passed, and then spending hour after hour on the phone trying to get someone to pick up the phone. So given that reality, it's hard to imagine that it can't get better. There are also reasons to think that an infusion of money will help. The agency has seen a dramatic decline in the number of employees that it has. And, let's see, I had some numbers here in front of me, but the agency, there are excuses that get made, and then there are real reasons behind those excuses too. The agency since 2012 has lost like 13% of its staff. It's got like the same number of staff now that it had in 1974. Right?
Oh, wow.
That's like kind of crazy, right?
Yeah, the population in the United States is not quite the same as it was in 1974.
Right. And so, we might want to make legitimate criticisms about the agency and whether it's efficient or effective, but it's simply not plausible that it's going to be able to do a decent job without enough people. So the number of employees fell by 34% between 91 and 2020, for instance, and the population rose by 30% over the same period. So there's a good contrast right there. So I think that, given that reality, it seems quite plausible that an infusion of money and the hiring that is going to go on around that probably will improve taxpayer service. And we can talk about where this money is going to go later on, and whether it's going to be for an army of auditors or for something else. And the answer is both. But I think it's reasonable to expect that this is not all bad news, right? This is for taxpayers and their representatives. There is good news here as well as maybe, so frightening news, bad news. I don't know. What do you want to call it?
Well, to me, this is the Accountant Full Employment Act. So, if you were ever worried about, how much you can bill, ever worried about getting enough work, I think those worries are over. But on top of that, I do think it's going to reduce some of the frustration of the profession, because it's been very frustrating when we have to pay. So there are private services that will get in line for you, and you pay them like $400 a month, and you can make a phone call and you get connected with the IRS in 3 minutes.
Right.
So basically that's what we've been doing, right? Is we're paying to get in line, and the people who can't do that or don't know about that, they're not getting that service. We're hoping that not only will be the regular phone lines, but actually the taxpayer, the taxpayer professionals hotline,
right, which has also been impossible.
It's been impossible because they've moved those people to processing, right? Yeah. They moved the practitioners hotline people to processing, and so hopefully they will. So I think that's number one. Now, would I have liked to see more than $3.5 billion of the $80 billion go to customer service? Yes, I would have liked to see 10 or 15 billion go to customer service, although they can do anything they want with that 28 billion, right? So hopefully some of that will also go to customer service. What do you think about technology historically? I mean, this is like, we have the worst technology of probably any industry in the country.
It's actually, it's honestly a puzzle, right? Like the IRS has been trying to modernize its computer system since the 1960s, right? Right? And now we're trying to modernize those systems from the 1960s still. Like it's crazy. And as a historian, I have looked at this to some degree, and in the 60s, they're talking about, well, we have computer problems. They're really outdated. We don't know what to do. We still have the same systems in place that we had in the 70s or whatever. They still have computers programming in COBOL, right? Which nobody alive knows how to program anymore. And you know what? They were saying that they were making these same jokes about COBOL in like the 90s. Yeah. Right. And now here we are, and it's 30 years later.
So this is my question. So why are they just putting only $4.5 billion towards this? Why not put $40 billion towards this? That is seriously, that's my biggest question is, okay, we've got $3.5 billion going to customer service, $4.5 billion going to technology, which I think are the two biggest weaknesses of the IRS. I don't think the biggest weakness is their enforcement. I think the biggest weakness is the other two. And yet instead they're putting $45 billion towards enforcement. Now, could they use that for technology? Yeah, but here's the big question. I think this is the elephant in the room, Joe, is have we, and this is the question I have for you as the historian, has the IRS ever before had a mandate to raise additional revenue as opposed to just administer the tax law?
Yes. Well, I mean, so the answer to why we're putting $45 billion into enforcement is that improved compliance is a money raiser, at least in theory, right? And people have been making that argument for a long, long time. I mean, that argument goes back, at least as far as I'm aware, at least until the 50s. And that's when we first have really like a mass-based income tax that millions and millions of people are paying. Before that, the income tax is just a problem for people who already have accountants for other reasons. So that's the first time that you actually have an issue with a real compliance issue on a broad scale. So beginning back then, they're already talking about, hey, you know what, if we put money into improving compliance, we'll get more than that investment back. So they start talking about that in the 50s. They've been doing it ever since. I know that when I first got to Capitol Hill in the 80s, they were already talking about using, increased enforcement funding as a revenue raiser, as a way to.
Have you actually seen it in a bill before, though? Because this bill actually directs them to raise revenue, and actually includes that in their pricing of the bill.
Yeah, I can't recall exactly how it's been handled in the past, but I think that there have been, for sure, there have been budget increases in the past that have been defended in those terms.
Yeah. So, but here's my concern. It's kind of like if you're the city and you say to your police officers, your job is to bring in more revenue. And so your job is to give more tickets because we depend on that revenue to operate the city. And what you'd like to see, at least as a citizen, what I'd like to see is the police officer actually, enforcing the law and making sure that the highways are safe rather than bringing in revenue. And I know it's a slight distinction, but I think it's a very important distinction. And it's one that frankly scares me because of some of the positions the IRS has taken lately about clearly allowable deductions in the tax law, and the IRS is just throwing them out in mass. And, when now they have this mandate to raise revenue, will they do that much more of that? That's the big question.
I mean, I think that's always a risk for any agency that does the kind of work that the IRS does, right? Because as you said, it's true for police departments. It's true for any regulatory agency that assesses fines. That is just part of government. And it's been true of the IRS from the beginning of tax collection. It's certainly been true when they've tried to outsource tax collection, right? And that when these privatized agencies had a monetary stake in how much they could bring in.
That was really bad.
Well, and it's been tried over and over again. Starting in the 19th century, they tried it, and they've tried it quite recently. So, I mean, there's always that kind of conflict, and certainly there are dangers in that. But I guess I think at some level we have to depend on. First of all, the law to protect taxpayers, and then on the professionalism of the agency. And there's no way to protect yourself completely from those pitfalls, right? I mean, yeah, there are pressures on the agency to bring in more revenue, but there are always pressures on the agency to bring in more revenue, even whether Congress directs them to or not. So I just think that's sort of comes with the territory.
Interesting.
And if the tax gap were smaller, let's say that if the estimates of the tax gap were that they were collecting 96% of taxes that were due, then the danger would probably be greater that they were going to be pushing the envelope. But we're pretty far off from that.
Where are we right now? Do you know?
I mean, estimates vary, and I don't know how accurate they are, but the most recent ones I've seen are something like 85%.
85%, which actually, by the way, if I've done my studies right, is one of the highest in the world.
Oh, for sure. But it varies quite a bit depending on what kind of taxpayer you're talking about and what kind of income they have, right?
Sure. So let's talk about that. Let's go to that one because the president keeps saying, oh no, people under $400,000 are not going to get audits. It's going to this is going to be the rich people, and I'm going. Yeah, but that's not what Janet Yellen said. Now, Janet Yellen said the proportion's not going to go up, but the proportion already is 90% of the audits are under 400,000. So if that proportion doesn't go up, that means that 90% of this, maybe not 90% of the money, but certainly 90% of the actual audits will still be under 400,000 because, if you look at the IRS numbers, that's where a lot of the tax gap is in that $100,000, $200,000, $300,000 range.
Yeah. I mean, so it really, where you find the tax gap is not with wage earners, not with salaried people, but with small businesses.
Exactly.
Anything that doesn't involve third-party reporting. You have a much bigger problem with compliance. So yeah, that's going to be, that is where it's going to be. So look, the reason why there are so many audits for non-rich taxpayers. Well, there are a couple. One is that we do a ton of audits for people who receive the earned income tax credit.
Right.
And that's partly because Congress requires it. And it's partly because it's easy for the IRS to do them. All they got to do is send letters. All those audits are done.
Well, it's also easy to commit fraud in that area because it's money that's coming back regardless of whether you pay tax.
Right. But it's easy for the IRS to keep their overall audit numbers high when they're auditing EITC recipients, because they just send out a bunch of letters, and they can do that even when the number of auditors they have on staff is dropping.
Got it.
So those numbers of auditors are dropping. They can't really do the tough audits anymore. They can keep sending out all these correspondence audits to the EITC people. That keeps Congress happy. So it's sort of like Congress and the IRS together conspired to audit an awful lot of poor people. That makes the percentages really high of total audits that are done on these people. So whether or not those are, there is a reason why you might want to audit EITC recipients, but it's also
easy.
It's also easy for them. It also serves their own purposes.
Got it.
Now that's probably not going to be what happens with all this new money, because they're going to be interested, as we were just talking about, in getting some return on that cash. And the best way to do that is going to be to audit people who are higher up the food chain. Now, whether they're over 400 or whether they're, say, like small business owners who are between 100 and 400, that remains to be seen. The administration says it's not going to be those people. And yet there was a statistic that I saw. I think it goes back to 2019, where there were 250,000 S corp returns that reported over $100,000 of net income and paid no salary, no wages. Mm-hmm. And, that by itself, it's like, this should be easy pickings here, right? Because it's pretty clear you have to pay wages if you have a business. You can't just take it all in distribution. So to me, that would be easy pickings, and seems like they had to go to easy pickings. But let's go to that more complex, because they keep talking about, we're going to go after pass-through entities. We're going to go after partnerships, especially. And of course, they started with passing the new law so that it's not quite as hard as it was under TEFRA in order to audit these partnerships. But the challenge, of course, is going to be, where are they going to find the auditors who are sophisticated enough to do this? Because I've been in this business over 40 years. I've yet to meet one who could audit a partnership. Yeah, I mean, that's always been the IRS's problem. I mean, in recruiting staff for any number of positions. And so we all know it's hard to hire anybody for anything these days, right? Yep. But it's always been really hard for the IRS to hire people for the most technical positions that they have, because they can't compete with the private sector. And I mean, we can find, complaints from the IRS going back to the 1920s in which they say, man, they're hiring our best people out from under us all the time. And sometimes they come here for a year or two and then they're out the door. Especially true for attorneys, actually. They have a really hard time holding on to attorneys, because those guys can triple their salaries just by walking out the door. So this is always a problem. I don't know that you can actually solve that problem. You certainly can't solve it quickly, and it's going to require a ton of training for these guys. It's going to be, this will be years before they really get people up to speed.
Well, so my question, Joe, is, do you think that they'll just go to checklist audits where they say, well, you need to meet these requirements, else you don't get the, for example, a lot of flow through entities hold real estate, right? Which will have had a cost segregation, taking the bonus depreciation since 2017. It would not be inconceivable that the IRS auditor comes in with a checklist and says, you need to meet these rules. And if you don't meet these rules, we're just going to disallow it. Similar to what they've done with captives and conservation easement, and say, well, we're just going to wholesale disallow it, take us to court, which I think is a really challenging issue for those of us in the CPA profession, because first of all, our clients don't want to go to court. They don't have the money to go to court, and it's really going to be cheaper for them to pay the tax 90% of the time. So do you see that as a likelihood, like I do?
Yeah. I mean, you're in a better position to judge that than I am, honestly. Like I think that, I think that's hard to say. That probably is a bigger issue in the sort of, in that income range that we are talking about right now, right? This like sub 400 like range that the administration swears is really not going to be the focus of this new enforcement drive. I think that the question there is, how seriously do you take that pledge? Because if you don't take it seriously and you think that there are going to be a lot of audits in that range, then it is, I think, I can understand the worry that there are going to be shortcuts. I think that because that I do think is where it's most likely to happen. Other, people above that range are going to be less concerned about the prospect of having to go to court. I think, but
although it's pretty expensive to go to tax court these days,
yes,
it runs,
yes, it is.
It runs anywhere from $500,000 to $2 million to take a case through tax court. So
right.
It's not an inexpensive proposition. Fine. No. For, you're talking about big companies, but big companies are audited every year anyway. Those are the
right.
large audits, and they're always audited. So that's not going to change. I mean, that's 100% to begin with.
Yeah.
So you're looking at this from a different perspective, in Washington perspective. Put yourself in our shoes, and when you're a CPA, what would you do to prepare for this?
Oh man, I don't know. I mean, there's definitely, there's so audits have been unusual lately. They are going to be a lot less unusual. I think that they are. It's you said that a lot of CPAs out there haven't had to really deal with an audit. I think that's probably that's probably been a very comfortable existence that is not likely to continue. I think the chances of being audited are going to rise significantly for most taxpayers in the years ahead.
What do you see that rise being? I mean, historically, if you added, because this almost doubles their budget, right? So what would you see?
Well, it's going to take them a while, though. As you
said,
will. It's going to take years,
3, 4, 5 years, probably.
Yeah. And there's a lot that can go on in those 3, 4, or 5 years. There's a lot of politics that can change between now and then. And as has been obvious, the Republicans have not let this issue go. Tax compliance and IRS funding used to be a more bipartisan issue, but it is not anymore. And so the congressional Republicans have been very hostile to this increase in funding. And I could see it turn around. Look, next year, whatever, 2 months from now, the Republicans could win both houses of Congress. That could change things dramatically. The IRS funding was cut dramatically under Obama, because even when he was president, because there was a Republican Congress. So I guess what I'm saying is, I don't know that I would bet the farm on this going forward for years. I do think it's likely to go forward for a couple of years, a few years. And one thing that I do think is significant is that presidents tend to be supportive of increased IRS funding, regardless of the party they come from. Every president since Ronald Reagan has supported increased funding, including Donald Trump. Because presidents have a vested interest in it, right? They run the agency, and they like to see it bringing in money.
Although with George H.W., we did get a kinder and gentler IRS, and things really did change when he came out with that. They were pretty harsh prior to President Bush, number one, and they became it did become much easier to work with the IRS after that. But I think in the last few years, because of the funding issues, it's actually flipped the other way. It's gotten more difficult. So I think a lot of CPAs are looking forward to some of the new funding. But the question is how to handle those audits when they come, because they will come.
Well, so I guess what I'm just saying, though, is that I think that I do think it's wise to prepare for the reality of an increased audit regime. But I don't think that that's necessarily going to go on forever, because the politics of this are far from settled. I wouldn't have said that 20 years ago, but I do think that that's true now. And you could see a reversal of this pretty readily, depending on how big politics goes. This is a live issue still.
Interesting. So thank you, Joe. Where would we get more information about you and what you do?
Most of my stuff is at the Tax Notes website at taxnotes.com, but specifically we have a tax history project there that you can find on that website. That's where my stuff is.
That's awesome. So thank you so much. And thanks everyone for listening and watching this particular podcast. I do believe that we are going to get audits, and we need to be prepared. Our job is to represent the taxpayer. We do not represent the IRS, despite what sometimes the IRS seems to think. We do represent the taxpayer, and we are their advocates. And when we're great advocates, remember, this is more work. So this is something we should be billing for, and billing at premium rates, frankly, because it is very valuable work. It can save the taxpayer a lot of headaches and a lot of money. And when we do it, we're always going to end up with better clients and a better practice and a better life. We'll see you next time.
You've been listening to the WealthAbility for CPAs show. Better clients, better practice, better life. To learn more, go to WealthAbility.com.